let's talk about Dell. For those who don't know, who is Quest?
Quest has been around for about a quarter century. Their specialty is building software that kind of automates maintenance tasks for databases. It's really not sexy, but it's a really key piece of the kind of technology that Dell wants to invest in. Dell wants to get away from low margin, consumer exposed PCs. They're not doing so well, partially because of the last segment you just talked about, the iPad. iPad is killing the PC business on a lot of fronts. And so Dell wants to be more about an IT services and software company. This is potentially a good move for it. The Quest has about $858 million in annual revenue, does pretty well. And so its initial plan had been to go private. And it was going to go private with Insight Venture Partners at about $23 a share. Well, Quest had a go shop period and started shopping itself around to see if it could get a better offer.
Right, Insight Venture Partners first made that bid back in March, correct?
May.
It was in May, okay.
Mid-May. And so that was the plan, and everything was going to go well, and they were going to go private, and then suddenly Dell stepped in as an unnamed strategic investor, or a strategic bidder, but everybody knew it was Dell. It was, I think it was 2.3, 2.2, something like that.
$28 a share.
Yeah.
Yep.
So ultimately it was $28. So Insight went and raised some more money with Vector Capital, and they came back with another superior offer. Dell stepped in yet again as a silent, masked avenger of a strategic bidder and bid once again, and so it was a back and forth kind of thing, and finally Dell closed the deal today.
Dell ultimately won. Tell us a little bit about how this fits into other acquisitions that Dell has made this year.
Dell has been on a bit of a binge. It acquired Wise Technology, which makes these things called thin clients, but are now sexily or fashionably called virtual desktops. It's all about cloud computing, but they're really just dumb terminals that talk to the network. We don't know what they paid, but it's about $400 million. Bought Clarity Solutions and another company called Make Technology. Those were 3 acquisitions in 3 days.
We're looking at Sonic Wall as well.
Right. Sonic Wall was earlier this year. By far, that was the biggest one until Quest. That was $1.2 billion. Sonic Wall is a security company, used to be public, was run by a guy who used to work for Apple, and Matt Medeiros was his name. And then he took that company private. Dell bought them out for $1.2 billion. But Dell has also been kind of on a long-term acquisitive strategy. Anyway, in 2010, it got into a bidding war for 3PAR with Hewlett-Packard. That went for, I think, 3 or 4 weeks before Hewlett-Packard finally walked away with 3PAR for $2.4 billion. Caused Michael Dell a great big headache. It even caused him to talk about it at Davos the following month, where he said, oh yeah, HP paid way too much for 3PAR. And of course Dell had to settle for Compellent, but what it did was it ticked off a buying binge for storage companies. That you had IBM and EMC, and ultimately Dell bought Compellent for $960 million in 2011, but it kicked off a buying binge for storage companies in the IT sector.
Now, we were just looking at the stock chart a bit earlier, Dell edging down. It's not that much of a surprise, really, that investors are getting a little skittish after an acquisition. What's the long-term view right now for Dell?
Well, the longer-term concern is, can Dell make this transformation? It is still very much exposed to PCs generally. I mean, Dell will tell you that it is 50% an enterprise company, but a big piece of that, of its enterprise business, is actual PCs. Half of its enterprise business is actually enterprise business PCs, and a lot of companies are holding off, waiting for Windows 8 upgrade, waiting for hardware upgrades to come along, and so that's one piece of the pie. But the other concern is cash. I mean, Dell started paying a dividend to make its shareholders happy, but now it's got to basically buy itself into technology that it didn't historically have. It's never been a particularly innovative company, so it has to buy a lot of that innovation that it didn't bother building while it was primarily a PC company. And so it's going to have to spend a lot of money, and with paying a dividend and acquisitions, a lot of analysts are concerned that the money may run out.
Right.